Edward, I mean, first off, make sense of what's happening in China. Bad data coming out. China pretty clear that COVID-0 will persist. But, you know, when you take a look at the market, swinging between gains and losses, how are you making sense of it all?
Yeah, I think the bigger question that asset allocators like us are asking is this a new regime change? You know, I've been in this industry for almost 25, 30 years. We have worked on the premise that China globalized. But right now, what happens when China starts to look insular in their approach? So I think the bounce that we are seeing is still lots of uncertainty underpinned, you know, in terms of both the macro as well as domestic politics. The bigger question we're asking is China investable? And then we're still scratching our heads on that. Yeah.
Well, the thing is, even if China is turning insular, are there opportunities given where levels are right now?
No, actually, if you were to take on the worst case scenario, Russia at a recent trough trades at 6 times PE. China is trading about 7, 8 times PE. If you strip off the internet, the tech boom that China had, China used to trade about 7, 9 times PE valuation. So we are at fair valuation for China. We are not cheap. On the worst case scenario, if it's ever trade into the likes of Russia, we're talking about 6x, so that's quite way down. So we're generally quite cautious on China equities.
When you take a look at what Goldman is saying, there's an opportunity that Chinese stocks could go upwards of 20% once it opens up. Do you want to be ahead of the game, perhaps positioned for that already or not?
We have a China A-share exposure throughout this whole crisis that we still hold it. I think that's positioned enough because the bigger question we're asking here is, you know, what happens when China strips itself off the global economy and start to look insular? You know, the whole private enterprise, state-owned enterprise regime that has changed. How do we factor all of this? And frankly, we're not too sure yet. Yeah.
This is it, though, Edward. I mean, to work out whether it's investable or not, you didn't really give us an idea of this, but it's not just being more insular. It's, as you also alluded to, becoming more ideological, and that's the head-scratcher, isn't it? So if China's the head-scratcher, who's the no-brainer?
Well, the no-brainer is to go to U.S. equities. It's the biggest market in terms of the constituents to the MSCI World Index. Opportunities are a lot more there. And let's not forget, we had many instances where unilateral retaliatory measures were applied against China. How do you factor that in your analysis of a company? It's very, very complicated. So, you know, I take my bets to other places like in U.S. equities, yeah.
Yeah, as an asset allocator, you probably will pass through the details of the non-farm payrolls report. What did you actually come up with in terms of your any new or possibly a reaffirmation of some of your investment strategies?
Right. We are actually managing our portfolio on the premise that we will have a recession, in fact, a global recession. When I look at jobs data, whether it's non-farm wages or the jobless claim that's coming up tomorrow, we have to remember job data lags the real economy. Simply put, you know, when the economy is at the cusp of early recovery, and companies don't employ people, they'll work the existing employees harder. When we have a real full-on recovery, we basically increase our payroll. Likewise, when demand softens, we don't immediately fire. But, you know, when things really craters is where we start to lay off workers. So I think we have to look at the economy more than the job data because job data lags the economy. And on that front, whether we look at soft data or hard data with regards to the economy is slowing dramatically.
You use the word dramatically. You know, what are you looking at in particular in terms of the data sets to come up with that?
Well, if you look at soft data, you know, we have plenty to look at. You can look at PMI, dissecting between manufacturing and services. You can look at OECD. You can look at conference board indicators. All of these soft data are either already at its contractionary level or at the cusp of that contractionary level. And they have moderated significantly from the peak several months ago. Hard data, whether you mentioned earlier, exports coming out from Asia, those numbers doesn't look that good, both in terms of China demand as well as the global demand. We look at hard data like housing markets across many regions are not only in negative territory right now, right? We have Australia, US, Sweden, New Zealand. We've seen housing starts, housing sales all in the negative, double-digit negative. And we are actually seeing at the cusp of perhaps some ASP decline, selling prices decline in some of these regions as well. And bear in mind, the housing market is a very big function of any economy, not only in terms of the banking sector, but as well as to the commodity sectors as well. So tellingly, you look at commodity prices in the basic material commodity prices, every one of them is down double digit. Aluminium, steel, copper, all of them are down double digit.